welcome to another weekly run through of the weekly macro themes report. Now this is a slightly older edition, and basically what we're doing here is going through one of the topics. This week's edition, there's a couple of very interesting topics in here, particularly on the Europe front, but what we're going to be focusing on is topic number 5 there, China tailwinds and tops. So let's go straight to it. And it's probably a good chance to just point out how the report works. So there's a couple of pages of charts with a bit of context around the charts, and then a bit of a narrative or commentary that ties it all together, complete with a bottom line which tries to take all of this and all of the insights from the chart and put it into one line. And the bottom line for this one is this: with the tailwinds from property, stimulus and trade looking to be topping out or turning, the China macro picture is likely to be softer next year, and this will be important for global downside risks. So yes, it's very important to keep an eye on what's going on in China. I mean, a lot of investors I see sort of have this view or this complacency that for example with American markets, that global doesn't matter. And when it comes to China in particular, it's a market that really matters a lot for the global risk outlook, for the global demand outlook, especially in that how it impacts on commodity prices, how it impacts on global trade, and just overall risk sentiment. I mean, some of the last some of the recent corrections, major corrections in recent history have been driven out of China. Like if you think about the late 2015 market correction, now there was a few pressures building up there, but really the trigger was China. It was the renminbi devaluation, the shock devaluation that happened then. And again, in the second round of the correction in January 2016, that was also driven by China. And when the China stock bubble burst back in 2007, that was probably one of the first shot across the bows in terms of the 2007 market top. So I mean, I can go on at length about that, but I think it's fair to say, and I think that most people will agree, and if you don't agree, please do go ahead and argue your points in the comments section of the YouTube video. But look, it really is a key one to be on top of, particularly going into 2018. And so what I've got with these ones, I'll go through these charts one by one, but at a high level, really what it is a look at how some of the big tailwinds, and the China macro picture has been pretty good this year and the last sort of, I guess, 12 to 18 months. And it's witnessed a considerable turnaround from a really slow point where you had this convergence of a cyclical slowdown and a structural slowdown. And narrowly they averted recession, in my view. And a big reason for that was really these charts here. So in particular these ones. So if you look at this one on the left here, it's a combination, or just a display of a few different leading indicators for China property prices. Back in 2015-16, when the slowdown was most apparent, you would have seen that black line would have been down here, and all these leading indicators, with a lead of various from 4 to 9 to 12 months, would have been all pointing to a big turnaround. And that was one reason, we weren't in the doom camp there. Certainly now we're in the camp that says, well, probably the best of this cycle for China has been seen, and certainly there's risks of a slowdown, this cooling off in the property market turning into a slowdown. The other thing that really helped turn things around there was this chart on the right. So it shows you in the blue line China monetary conditions, and you can see their very sharp shift in policy stance as well as overall financial conditions. And that has started to pull back now. So again, it's very much mirroring the conclusions and sentiment in the left-hand chart. And also in the black line there, that's the fiscal impulse, and that's just budget deficit, percent of GDP, year on year, the year-on-year change in that. So the impulse of that, and as you can see that there's a significant drive there, 2015, 16, very expansionary push, and that's gone to the opposite direction now, as you'd expect. So that's probably the key two charts to think about on China in terms of the tailwinds. They were massive tailwinds on the stimulus front, very big concerted effort there, and now that's starting to fade. Not tightening in a huge way, but certainly it's no longer going to be a tailwind, and should that direction continue, it'll start to become a headwind. Same thing with property. It was a massive tailwind, and now going into 2018 could become a bit of a headwind. And I think that these ones will take some time to roll through. So it's not necessarily going to be a January, February 2018 thing. It could be more of a mid 2018 beyond kind of thing in terms of when crunch time really comes. But it does go to show that, I guess, what I've been talking about with clients is that one of the key themes for 2018 is the maturing business cycle, and certainly that's going to be the kind of thing that you would see that would be accelerating the maturation of the business cycle in China. And then I guess probably just a quick look at those two property charts there. I mean, those are really just showing a bit of background behind that one. The big turnaround there, and now a bit of a slowdown or deceleration cooling off. And the last two here, I guess probably best to talk about the one on the right first. So this is the export aspect. So you can see there that in that 2015-16 period, not only did they have, monetary conditions were actually very tight then, property market was in a slowdown, and exports were likewise in the toilet. So that's had a big turnaround. Part of that's been down to the currency. You can see in the light blue line there, that's the real effective exchange rate, rate of change with a 6-month lead, and you can see there that it's still consistent with expansion, but that big turnaround, part of that was base effects, has already sort of started to roll over. I guess the way that the currency has strengthened in the last 6 months, it's probably not enough to act as a real headwind to exports. We probably need to see more strength for it to really act as a dampener on exports competitiveness. But I guess it comes down to the global front. Probably fair to say that exports will remain, a net contributor, but the pace of change is probably not going to be as significant. I guess on the one on the left hand side, probably on that one. So first of all, explain what it is. The red line is Google Trends search interest, and that's for the term USD-CNY. You can see there that it's completely fallen off everyone's radar. It's gone for a period of strengthening, and there's a few reasons behind that. But I guess, one other positive, in recent months has been the relative calm, and that, the whole concern about a devaluation has gone out the window. Nobody's thinking about that anymore, and you had a bunch of big name hedge funds capitulate on that trade, and with good reason. With prices going against you like that, why do you fight it until you see a more compelling setup? And 2018 is probably going to bring a more compelling setup. I mean, these here tailwinds turning to headwinds, big driver on the macro front, and in the background you've got the Fed steadily tightening policy. And yeah, if you see the Chinese property market go into this kind of slowdown, if that cooling off turns into a slowdown, then that'll change the game in terms of monetary policy there. Their desire at the moment is to try and match what's going on in America, so that they don't get this devaluation pressure, this capital flight pressure. But you know, that means basically importing the policies of America. And when you've got your housing market cooling down and you're importing tighter monetary policy, probably not the best of things unless you really want your housing market to go into a proper slowdown. So, you know, they're stuck in a bit of a difficult situation. I would say that probably now more than ever, China's economy is increasingly interest rate sensitive. So, you know, if the Fed just does a very simple and slow 75 basis points of tightening next year, then maybe that's not that big of an issue. But you know, if you're like me and you think that the Fed's probably not going to do 75 bips, that they're probably going to either do nothing, or you know, probably something like a you know, double or triple what their best intentions are, then that'll create a whole different risk backdrop for the exchange rate there and the overall macro risk outlook for China. So you know, it's been a big turnaround, and quite a, you know, relatively positive story on a cyclical front in China over the last 12 to 18 months. I think that next 12 to 18 months are going to be a lot harder. So that's definitely one that you need to be having in, at least in the back of your mind as we head into 2018. As I said elsewhere, it's we've had a pretty easy ride in 2017, and I don't think that 2018 is going to be as easy a ride. Still a lot of positive trends and themes that are still underway, but you know, as we get as time goes on, as things like this that I've just talked about start to play through, it'll become increasingly challenging. So look, I'll leave it there, and if you've got any questions, comments, anything that you'd like to add, do go ahead and put them in the comments section below. Otherwise, please subscribe to the channel, and if you like what we're doing here, like the charts, then you're probably going to enjoy what we're doing on Twitter and LinkedIn as well. So I'll put those links there into the description of this video.